You've been given a green light to take all that cash under your mattress and put it in the stock market according to BlackRock. You came here for the truth, so let me unveil that for you. In today's video, we are going to look at what BlackRock had to say and why this is so important, because the prices that you pay for stuff is going to be much more expensive next year than it is right now. I'm going to make these connections. I'm going to show you each and every detail here in this video. So let's begin. This is what they said. The Fed's decision is a green light for investors. BlackRock, what are they talking about here and why is this important? Well, let's look very carefully at this. Right now, at this time, the Federal Reserve has basically signaled that we're probably at the end of this rate hike cycle, and at some point in the near future, there are going to be rate cuts. Now, that isn't officially a pivot, but what happens here is that investors would look at this historically and say, during these periods of time, what is the chance that the stock market goes down considerably? And so they would weigh those options out. The thought here is that they are going to front run the eventual rate cuts, which would be very bullish for stocks. Hey, I'll take the risk. I'll dump the cash in so that I can get ahead of this. But what happens here is all related to inflation. That's the big thing. And here we have it, inflation today versus the 1970s. They're putting these in parallel and kind of saying, you know what? There could be a resurgence over the next little while. Who knows? Who knows where it is? In the 1970s, it was wild. There were different things happening there. We have the oil shocks and so on. But the thought is, if we don't take care of inflation now, it resurges even worse at a later time. We know that. And so what the Federal Reserve has said is, hey, we're going to make sure we're going back down to that 2% mark and so on. What they signaled, though, and I watched the press conference, is that they want to make this clear. They're not going to wait for it to go to 2% to then cut rates. That is not what they're going to do. And the Bank of Canada has said that as well. I mentioned this in the comments to somebody, and they didn't understand that. And it's important to note this very clearly and carefully. It has been indicated as of this last meeting, okay? If they wait to 2% and then they start cutting, then they will overshoot. This is what Powell said. It will overshoot because there's always, back in time. It's always going to be a lag. And so they've got to be aware of that. They're cognizant of this. And so anytime now, they could start to cut rates because they don't want to overshoot on that 2%, go down to 1%, go down into the negative. And so what they want to do is some point in this near future, they want to start cutting. You got to realize that. If they are going to cut, and if they're going to stop the quantitative tightening, what does that do to asset prices? That's right. And if asset prices rise, well, what happens to the wealth gap? It gets bigger. Right. Stick with me, okay? I'm gonna connect all these things together. These are the financial conditions. And so many people have said, wait a minute, but they're not printing money. How is the stock market going up? Well, what is this? What's going on here? Well, know that there's so many factors. It's not just QE. It's not just quantitative easing. You have the financial conditions index, and that's made of different things. You've got obviously the interest rates are in there, but there's, a whole bunch of different things. It depends on which conditions index you're looking at. But when we look broadly at happens to be Goldman Sachs, but the financial conditions index, it has come down to the levels we haven't seen since the middle of 2022. Okay. And knowing that, it tells us that there are several things that are factored in here that investors are taking into account. And as a result, making it look much more attractive to be dumping cash in. And that's what has been happening. Investors do not feel concerned right now overall, although money market funds have been, flooded $6 trillion worth in money market funds. Clearly, right now, you can see how much cash has been flooding into stocks, though. I mean, it is crazy. That blue line there, that shows us the world market cap, and it has just gone up, up, and up. And so when I see that, it tells me that no, there really isn't a concern overall. Overall, I mean, investors have been dumping cash in. And that's one indication of financial conditions as far as I'm concerned. Because if we were really truly concerned, all these investors, they would be dumping their money into gold, they would be dumping their money into bonds, they would be thinking, you know what, I don't want to put my money in stocks because of the potential volatility. And if there's a real big recession, then I gotta look at that and think, no, those companies are going to be hurt. Their earnings are going to be hurt. Profits are going to be hurt. So I won't invest in that and so on. Clearly not happening, right? It's an odd circumstance. Let me tell you. This is showing us index valuation has typically expanded following the first Fed cut. So generally, when the Federal Reserve cuts interest rates, obviously it's bullish. That's generally the way it works, okay? You didn't need me to pull up that chart for you, but I just wanted to show you historically how it works. Not every time. It depends on what's happening. Like, why are they cutting interest rates? Why are they printing money? If it's because some catastrophic event, yeah, that's terrible. Maybe it's going to have a severe impact on the economy. And then, of course, that, the markets are affected by that. At this time, if you can believe it or not, 168 basis points of cuts in 2024 is expected. So that's 1.68% cutting. That actually seems pretty reasonable, right? We would be down quite a bit from where we are. On the Fed funds rate right now, it's at between 5.25 and 5.5%. So bringing it down to 4% seems pretty reasonable. To expect that. Who knows what happens by then? But shows us what could occur. Now that has been, you can see how it's been walked back over the past couple of days as I record this, because other members of the Fed came out and they started this like, Powell was being a little dovish, or, we're not quite there yet, and so on. Who knows? Number of consecutive up weeks for the S&P 500, going back to levels we haven't seen since 2017. That was the Goldilocks year. Each and every month, the market was up that entire year. And just looking at it, going into the same circumstance today, it seems like, hey, nothing's wrong, right? Well, the stock market just triggered an overbought signal that's typically led to a decline over the next month. More than 30% of the stocks in the S&P 500 just hit a 14-day RSI level above 70. And that is overbought, and you could see that here on this chart. What does that mean? It's just let's just make it simple. When it's above this number of 70, it's overbought, and here we are today, okay? All you need to know is that on a short-term scale, the market is definitely overbought because they love what they saw. They said, hey, easier financial conditions. I love it. So they put their money in. And businesses at the same time are watching that. They are potentially going to be, we'll see, easing up on their layoffs and easing up on everything. And I want to see them expand research and development, expanding their hires, and sort of flipping that narrative here in the first quarter of 2024. If that happens, then we know that the economy could certainly turn around, because it is a self-fulfilling prophecy, right? Oh, things are getting bad. I'm going to stop spending, and then that has a chain reaction. So we'll look at that when it comes to the companies and what they do. We won't know until in those first few months. Things for retailers and things, January, February, not a very good time typically. So we'll have to wait beyond that. This is interesting because the central banks around the world, generally, they are tightening up, but the People's Bank of China has continuously been expanding. They've been pumping cash into the system at a more steady rate. It's different in what they do. They've been just, slowly but surely, year after year after year after year, expanding their balance sheets, whereas ECB and the Fed have been doing this like aggressive up and down action. But if there is stimulus, where does it go? If it's China, is it staying within China? Does it somehow slosh around and make its way outside? That's the way the financial system works. Like in 2015 timeframe, the Federal Reserve says, hey, we're going to stop all of our programs. But the Bank of England, the ECB, there were other central banks, and the SNB, the Swiss National Bank, they were pumping cash into the system. And so that, floods around and eventually could make its way into the US markets. Okay. Looking at this, 152 global central bank rate cuts are expected in 2024. Crazy, right? What do you think that does? What do you think the effect of that? 2024 is set to be the first time since 2020 that cuts will be greater than hikes. There's a lot of stimulus. There's a lot of inflation that will come as a result of this, unless there's a huge recession, there's a depression, suddenly, hey, everything's bad, millions of unemployed continuously, the 10th cities just, 10x in size and so on. Otherwise, much more inflation. The prices that you pay for stuff now, today, will potentially seem like nothing next year and the year after that. Because of what they're doing, because of the stimulus, because of the continuous expansion of their policies. And this doesn't even suggest that there's going to be a recession. Look, if there is a recession, deflation comes in, what does the government do? Well, they look at it. Oh, it's affecting the car market. Oh, we'll bail out the car market. Here's cash. You want to buy a new car? Here's $5,000 for you. Everybody that wants to buy a new car, $5,000. And then they spend $1 trillion. That's stimulation, right? Central banks have their own way to stimulate. We've got to pay attention to this. If the government spends a lot of money, they are going to put pressure on the Federal Reserve to come in with a new quantitative easing. And of course, we know what that does. If you want to get this level of depth each and every week, beyond, actually, way, way beyond that. And in addition to that, the new GPTs. What is a GPT? That's basically using ChatGPT. I created my own system within that. I created my own GPT, what I call Fire Your Financial Advisor, which is basically a way that you can click one button, it will research the current economic situation, and then give you an output as to what is the best thing to invest in right now. And it compares that to history, looks at those circumstances, puts them in buckets. Okay, what is the current circumstance compared to these previous buckets? And based on that, giving you reasons why. Not just saying, oh, go invest in Microsoft. No, it gives you the reasons why. Very, very exciting stuff with the GPTs. That will be available to the public in the first quarter of 2024. I would release it today if it was available, but the whole thing that they're building with OpenAI is not available until first quarter 2024. I spent about 6 hours creating that, and that's part of the weekly sessions that I have. The link will be in the description. You can get all the details for that right here at that link. And the comment of the day: the debt is unpayable and will be hyperinflated away at the expense of the middle class. And I want to know what you think about this. Do you see hyperinflation coming or just more inflation? I don't have hyperinflation as my base case. It would be very hard to hyperinflate the US dollar. The US currencies there has been 2 hyperinflations that have occurred before. Today's a very different circumstance. I do see more inflation though. There's no question. Deflation, if there is any, will then be met with more inflation. So temporary bout, more inflation, hyperinflation. What do you think? Please let me know. Hit that thumbs up button on the way out, because not only does it support the channel, but it notifies this algorithm to say, hey, we got to push this out to more people. So I do want to thank you for that. And if you know anybody that would benefit from it, just hit that share button. And that's it. I'll see you tomorrow. Make sure you come back tomorrow so you get the latest and greatest information. Take care.